I recently did a video showing what stochastics are and how they work. In this video, I'm now taking it a step forward and showing you a very simple strategy. Now, this is literally in a sort of development stage, how I would look at things, but it will give you an idea of how strategies are built and how they may be applied to a stochastic. So, firstly, the stochastics themselves, just in case you're not familiar, they're an oscillating indicator, so they oscillate between 0 and 100. George Lane actually developed them back in the late 50s to actually trade stocks with, but they work just as well on commodities and currencies. And it was really designed to show overbought and oversold signals. That was his first goal, and that's what I'm going to work on with this very simple strategy. Now, the data is then shown for the stochastic calculation is based, as I said, between 0 and 100, and that gives us this indicator. It's effectively a percentage basis. It shows the speed and momentum of price, and based on that theory, that momentum slows before price changes direction. It also gives divergences. But I'm leaving the divergence aspect for now and working on the overbought and oversold signal. Now, the principle is that we're looking for an overbought signal in a downward trend, for example, and I'm looking here at the short version. All you need to do for the whole of this video is write it out firstly for the short version and flip it on its head effectively for the long version. So really looking for overbought in a downward trend, oversold in an upward trend. So I want to really use the stochastic as to go with the momentum of the market that's already there, but it's really to catch these retraces, these oversold retraces and overbought retracements. You need to identify a trend. Now, in the calculation and the backtesting I did, which is a very simple backtesting I did on this, I actually looked at I based my signal to be set up when the price was above the weekly 50 SMA simple moving average, and yet the price was based on dailies, so it's a bit of a looking for trend off the weeklies, the retracements etc on the dailies effectively. It's up to you how you take this, and you can work on it even further. So I was looking for the short side of things here, then I was looking for an overbought or a plus 80 on the stochastic. Now it had to be below the relevant SMA, which I just used a 50 period for this particular example. Now the entry signal was when you've got to decide on a trigger. For me, this was a break back below the stochastic 80. I'm going to show you all this on a chart in a moment, so it makes much more sense. Whoops. So that's the entry, and it must be on the bar must be downward, a down bar. I don't want to be trying to sell on a upward momentum or movement. I want to see that the bar is a downward bar before I look to take the trade. And my entry would then be when I get the signal, which I'm going to show you in detail. Once I get that signal, it will be 2 pips below that price. So it just gives me a chance to, in case it just comes up as a double bottom and then reverses, I'm not in it. So I'll just put a couple of pips below. Now, depending on the time frame you're trading, 2 pips probably is on a daily is probably a little bit light, and you may want sort of 5 pips or so on a 30-minute, 60-minute time frame. 2 pips is probably ample. The stop would be above the near-term high when we made the plus 80 reading, and the target is simply exit the trade on the close of the bar when the stochastic is below 20. So we're letting it go from an overbought signal to an area of oversold. So we just clicking out at that point whatever profit is made. So sometimes it will trigger the trade and not make a lot of profit, eventually get down to that 20 point. You might make 0.5%. It's not necessarily a great return on it. Okay, Now, when you take this away, as I said, I've given you the sort of the hard facts here, and then I'm going to show you it. Make sure you backtest it. It's absolutely essential that you backtest. If you just take what I've shown you here and go off and trade it, well, firstly, the time period that I've tested here is probably, it doesn't give enough trades really for majority of people. I've tested this over 20 years. It's given me 30 odd trades, 40 trades. So it's not the right time period to get a more better trades, or more frequent trades. It's still profitable, but it just doesn't give me what I would look for. But you've got to take it away and test it for yourself. It will also give you it will give you an idea whether it's profitable and worth trading. And of course, when I say worth trading, I mean, is there frequent enough trade setups? Is it going to work for you? Okay, let's take it from there. Let's now go and look at charts and make this more usable for you. So this is a bit of a backtesting software I've used actually to do it. You can actually see where okay, let me just highlight every part of this. So actually, I was going to show you on this. What I'll do is here the signal actually came in a little bit earlier, and then it went a bit sideways. So what I'm going to show you is it on a trading view chart. If I can pick one up. Here you are. So this is when it was actually setting up. So that particular trade I'm showing you. So I'm going to just step it through step by step here, so you can see the stochastic even has now gone plus 80. So there's the 80 area. So it's in a downward trend. This is a 50 simple moving average. This is actually based on end of day a daily 50 moving average, but it shows exactly what we need to see here. This is a daily chart. Here's the stochastics. It previously got oversold, but it was in a downward trend, and that's fine. It can stay oversold for a long time, as I identified previously in the other video. Here what we've got is the price coming up here. It's getting overbought. Now what I'm waiting for is a break back below that 80 area to look to sell it. So just going to go, and you could just literally, this is an end of day chart, so it's more based on a swing principle. So we just wait for the next bar to come in. Okay, so we've got the red bar coming in, and it's triggered. It's gone below the level there. Now what happens next is you get an inside bar. Now it's really a question is, do you literally just go ahead and sell? Well, you can put the sell stop in here and put the stop remember the parts of the trade then. So I've got it below that point now. I've got red bars, so I can put my sell stop underneath here. It's setting on these two bars. There's two red bars. The sell stop is down there, then the stop loss is up here, so I can then carry on letting this run its way through. Now if it was to continue consolidating for some period, you might say, well, actually my rule is, if it's not triggered within 2 bars of the setup bar, I'm out of here. I'm not interested, because it's possibly going to just carry on doing something like back here where you got the consolidation and it carried on. So I don't want to be in that situation. So let's just press the bar again, and there we go, and it's finally triggered there. So it's taken longer than you might expect, but throughout this it's all a setup. It's triggered. If it had taken the high out first, you could have cancelled the before it triggered the trade, you would just cancel the whole principle. Here it's now running down, so you would be in trade, stop at the top there, and then you were just waiting for the signal to come back to the 20 area. So we click down 1 bar, so gradually working its way down. Another bar. Whoa, stop there for a moment, and it's done it. So it's pretty much there. So at this point is you take the exit. Now you can see the risk reward wasn't fantastic on this. Actually, I'll probably place sell stop in slightly the wrong place, but it's not fantastic, and sometimes it just isn't. But you've got to determine whether you're happy enough with this principle, and take it from there. As I said, it is a very, very simple method. Now, next bar, let's just have a look. So you can see here it's actually gone further down, another couple of bars. My exit rule was just literally on the close below the 20, so that's it. You can change your exit rule slightly and see if you can take some more off. It may be that you take half off when it closes below 20, and see if you can get into another one of these sort of areas where it rides below the 20 for a while. But you could also look at if it actually sets the sort of the opposite signal and comes plus 20. So where I'm shorting and taking the short when it goes below the 80 up here, that's the trigger that way. So it's gone above the 80, so it's become overbought, and then I'm taking the trigger below that point, and then down here it's become effectively oversold. And then if I was trading above the 50 MA, I'd be looking for that as an entry. So that sort of entry could be your exit effectively, but not another trade. You wouldn't be looking to buy at this point because it's going against a trade. So if we run through there, you can see then what happens next. So you'd have been stopped out probably on lesser price at the end of the day than we got out originally by using that wait for it to come back theory. I found that just simply taking it by eye, the close below the 80 is going to give you as good a return as letting it run further on a lot of occasions, because it does just flick back sometimes. As I say, it's just got effectively oversold down there, but in this case it's pushed on a little bit further. Sorry, I'll just switch you back to here. So this was, there you go, there was the profit taken out of that one. Now, it of course provides losses as well, so it's not all about profits. Let's just look at, I mean, this was a back testing to just look at the statistics on this one. Personally, you'd need to decide on whether you wanted to trade this one. I'll just bring up the statistics for it. Stochastic weekly trend with a daily setup. So it's profitable, but I mean, this was over since 2003 to 223. It's scrolling up and down. There we go. It's not actually showing me the absolute bottom there on this chart, but it's basically done 13% over that period. So over 20 years it's done 13%. Now if you were putting that together, this is one currency pair, and if you had 8 currency pairs, you might think that return, if they all did something similar, it'd be worthwhile. But alternatively, as I said, it's done 39 trades over that whole of all that time, and for me it's probably just too light in terms of numbers of trades. I would look for something that gave something more, so in which case you'd look down the time frames. So it might be that you trade it off a 4-hourly time frame, for example, but then you might want to set specific timing points of when you actually enter the trade. But there you go. It's just this was just a principle showing you a very simple strategy. You can go and play with it now and hone it into something more significant. As I said, this is on a daily basis. Yes, it makes a return, but if you look at some of these yearly returns, they're very modest. This outperforms most traders on its own over those periods. I should think most traders are losing money, but if you were making 8% a year across 10 currency pairs over that time, you'd have probably been reasonably happy with what you had, and taking into account compounding and etc. It would have looked okay. Anyway, there we go. A very simple strategy, needs work on it. You've got to decide on as I say, the time frames that you're going to take the trade and set the setups in. It works on an hourly, but you need to test it and see how good it is for you. There we go. So I will leave it there. If you like this video, please give me a thumbs up. If you want more, make sure you subscribe to my channel. Take care. Bye for now.